So once again, good evening. And last week in our lecture, we gave you some assignments to do. We solved example 7 in the handouts. And I told you that example 8 is an assignment for you people who have looked at it or who is still looking at it. Who has tried his or her own hands on it? The example 8. There's nobody have done that. Okay. Do you have any questions? If you don't have any questions, then we'll proceed to the agenda for the day. We are going to continue our consolidated profit and loss accounts. And we started looking at it in our last week meeting. We did one illustration over there, and I also went ahead and told you that there is an illustration over there that is on PQR and XYZ. You have to go and look at it, or we will come and look at it. But in the meantime, you can still go ahead and look at it. Today, we are going to look at that particular illustration. So I hope you all have your calculators, your handout, and your jotters in front of you, so that whilst you do it along. And so this is the question we are going to look at today. I don't know which page it is in your handout. If somebody can help us with the page number, I'll be grateful.
Page 45.
Okay, somebody says on page 45. So those with the handouts, you open to page 45. So it's two things. So the profit and loss account of PQR and its subsidiary XYZ Limited for the year ended 31st December 2011 is as follows. So you have the profit and loss account given to you over there. Then you have the income surplus account following the profit and loss account. And there is an additional information. saying that included in the turnover of XYZ Limited is 5 million in respect of sales to PQR. The sales earning XYZ Limited a profit of 25% on cost. And these are sales of compounds that XYZ, I think this should be XYZ, not ZYZ. XYZ has been supplying to PQR on a regular basis for a number of years. And then they said these are sales of compounds that XYZ has been supplying to PQR on a regular basis. This amount is included in the stock of PQR in respect of goods purchased from XYZ at the beginning. At the beginning and end of the year was as follows. So the stock of compounds in PQR books. So opening stock is 800, closing stock is 600. Additional information too states that at the date of PQR's investment in XYZ, the balance sheet of XYZ showed ordinary shares of 25,000, reference share capital of 17,500, income surplus of 5,000. PQR bought 20 million ordinary shares, but no preference shares in XYZ at a cost of 27 million. On the same date, PQR bought 25% of the debenture of XYZ at par, and you are required to prepare the consolidated profit and loss account of PQR for the year, and goodwill on consolidation has been fully written off to the income surplus account by 31st December 2010. You can assume that investment income is dealt with by PQR on an accrual basis. So that is all the question, and you proceed to provide the necessary solution. Now, in the question, we are being told that goodwill on consolidation has been fully written off to income surplus account. So it is important for you to determine the goodwill. It is very, very important for us to determine the goodwill. So if you are being told that there is goodwill in the question, and this goodwill is being written off, then technically speaking, we must find that particular goodwill that is being written off. How do you know that you are supposed to find goodwill? Because, or how will you know that I'm supposed to do goodwill or calculate for goodwill and the profit and loss account, where I've not been giving anything in the balance sheet, or I've not been giving balance sheets? You can see that in the question, they were telling you that at the date of PQR's investment in XYZ, the balance sheet of XYZ showed. So they gave you the information you need to prepare the balance sheets. Now, we're told that the investment in PQR, that's my question. PQR bought 20 million shares, but no preference shares in XYZ at the cost of 27 million. So our cost of investment here is 27 million. So we are putting 3 zeros away. So investment cost is 27,000. We are being told that he bought ordinary shares and no preference shares. Now, the very first thing we also have to find is how much is the percentage holding? If you bought 20 million shares in XYZ and XYZ is having 25,000 shares, So who can find the percentage holding for me? We are having 25,000 shares, and the person is buying 20,000 shares out of the 25,000. How much will be the percentage he's getting? Yes, who is calculating it? What is the group structure? Nobody is calculating. $20,000 divided by 25,000 times 100. Nobody is calculating it.
Size 80.
Okay, no problem. If it is the solution you guys want me to put for you, I can just do them for you. Then we go
Hello,
out.
sir. Hello,
So
sir.
we have 80%.
80%.
And 80. So 80% of the 25,000. How much are we getting as the investment over here?
20,000.
20,000. We are being told that the pre-acquisition surplus is 5,000. You see it in the note 2. So pre-acquisition surplus is 5,000. So the same way, 80% of the 5,000, we will get how much? How much are we getting? 80% of 5,000. We are getting 4,000.
Yes.
So how much is our goodwill?
$3,000.
Our goodwill is 3,000. So this is how your cost of control account will look like for this particular illustration. You must also calculate for your consolidated income surplus. You must calculate for the consolidated income surplus. Now, before you calculate for the consolidated income surplus, let's go and look for the adjustments that we have. Pardon me, today I'm very, very tired. So you see that my voice is very, very dull. So pardon me for that. So let's look at our adjustments. What will you say? Okay, we are being told that there was an intra-group sales. And I told you that anytime there is an intra-group sales, there are certain questions you have to ask yourself. Hey, are you seeing my screen at all?
Yes, sir.
Are you seeing my screen? Are you seeing the adjustments? The adjustments I wrote, are you seeing it on the screen?
Yes.
Yeah.
Okay, all right. I thought you are still not seeing that one. Okay, that's good.
Yeah.
Okay, let's proceed. So anytime there is an intra-group sales, there are certain questions you have to ask yourself. Who is selling to who? The moment you are able to know who is selling to who, you will be in the position to calculate the appropriate unrealized profit. If you don't do that, you will not be able to do it. Now, in the question, we are being told that included in the turnover of XYZ is 5 million in respect of sales to PQR. So here, clearly speaking, XYZ is selling to who? To PQR. XYZ is a subsidiary. PQR is the parent company. So we are going to calculate our unrealized profit. I told you that if it is the subsidiary that is selling to the parent, then it means that whatever profit or loss that has been generated will be shared in the ratio or it will be shared based on the percentage holding. Okay. So in our case, it is 80-20. So if the subsidiary make a profit or loss, it will be shared 20-20. If it is the parent who is selling to the subsidiary, 100% will go to the parent. So you must have it at the back of your mind, question 2, that whatever unrealized profit you are going to calculate, if you get the unrealized profits, this unrealized profit will be shared in the ratio 80:20. Now we are being told that the markup on the sale is 25%. So markup is 25%. And you were given a selling price or the sales value to be 5 million. You know that you cannot match markup with sales. Sales goes with margin and markup goes with cost. So what do? You must convert the markup to margin. So in converting markup to margin, it is going to be 25 divided by 125. Multiply by what? 100. How much are we getting? Converting markup to margin. Converting markup to margin is equal to the markup percentage over the markup plus 100 or multiplied by 100. Converting margin to markup is the margin percentage over the 100 minus the margin percentage multiplied by 100. You said the answer is what?
20.
How much?
20.
20%. Okay, that's correct. So therefore, you are going to work with a 20% margin. Now, in order for us to know the unrealized profit, there are two ways to do it. We can say the 800,000 minus the 600,000 all multiplied by the 20%. We get an answer. Or the 800,000 multiplied by the 20% minus the 600,000 multiplied by the 20%. How much is the answer you are getting? What is the answer?
40,000, sir.
40,000. So therefore, unrealized profit is 40,000. That is how you identify the unrealized profit. Then you find your intra-group cost of sales. We are dealing with income statement over here. So wherever profit affects, you must take note of that. So the total sales value is 5 million. That's 5,000. Minus the unrealized profit 40. We say we are taking 3 zeros out. Or let me just write the 5 million for the ladies and gentlemen not to be confused. Minus 40,000. What is the answer?
$460,000.
496,000.
496,000.
40.
That is it. Now, let's do these workings because we'll need that figure. The 800,000 multiplied by the 20%, how much do you get? Because at a point in time, we'll need those figures so that will not come and be going back again for us to calculate. So let's do it now.
Hello, sir.
Yes.
The 5 million minus 400,000 is not 496,000. No.
What is the answer?
It's 460,000 rather.
Hey, accountant.
5 million
4
minus
million
400,000.
960,000. I'm born, I'm blessed.
The answer is 4,600,000.
Hey, 4,600,000.
Yes, please.
You mean 4.6?
Yes, please.
It's a lie. It's not 400,000 you are subtracting.
You
You are
say 5
subtracting
million
40,000.
minus 400,000.
It's 40,000. Sorry.
You wrote 4 million.
Ah.
That's what I died. No way.
The 800,000 multiplied by the 20%. How much are you getting? Please, you have to be fast so that we can move quick. How much?
160,000.
160,000. The 600,000 multiplied by 20%. How much are you getting?
120,000.
120,000. So 160 minus 120 will give you 40,000. Okay. Let's go and prepare our consolidated income surplus account. What is the opening balance of the parent company? Opening income surplus account. What's the total? Sam Raymond Kobina Nyamiche, you are disturbing us. Opening balance of income. How much?
26,700.
26,700. That's fantastic. The post-acquisition surplus is how much?
$105,720.
105,000.
720.
I disagree.
15,000.
How much is the total surplus?
15,000, sir.
Are you all seeing the income surplus account?
Yes, you can see.
Yes.
Okay. In your income surplus account, balance brought forward for the parent company is 26,700. The total surplus which would have been in your balance sheet for the subsidiary is the 7,800. Are you seeing it? If you should have gotten a balance sheet, or if you should have a balance sheet, that 7,800 would have been the surplus in the balance sheet for you. Are you getting the scenario? For the subsidiary.
Yes, sir.
And we're having a pre-acquisition surplus of 5,000. So to get the post-acquisition surplus, you pick your 7,800 there minus your 5,000 multiplied by the 80%. Now, how much are you getting?
$2,240.
2,240.
Like this.
Yes, sir.
Okay.
Yes, please.
We were told that there is an unrealized profit. Now, to calculate the unrealized profit over here, you pick the 80% multiplied by the unrealized profit on the closing stock. The unrealized profit on the closing stock here is 120,000. This one. You're interested in this one? So 80% of the 120,000 will give you how much? Let me do this thing here before, because this question is a little bit confusing. Some people will come and be asking why, so that I can write my 120,000 here. 80% of 120,000, how much are you getting?
96,000.
So you are getting 96,000. So if I write 96 here, you should understand.
Yes, sir.
Then goodwill is fully written off. So goodwill of 3,000 will be written off. So balance of the account. When you balance of the account, how much are you getting?
It's 25,844.
That's the total.
That's the difference.
Okay, somebody says 25,844. So the total is how much?
$99,000.
The total is 99,000.
Hey.
Hey. Hmm.
$28,940.
So 28,940 is your total. I'm in a class, I'll give you a call back. The next item you look out for is to prepare your non-controlling interest account. Now you are being told that the parent company bought ordinary shares, but no preference share. So what it means here is that for ordinary shares, the percentage holding is 80-20, minority is having 20. But for preference shares, minority will be having 100% because the parents has not bought any of the preference share. So you should have that one at the back of your mind. Now, let's go ahead and calculate or look at the minorities account. Minority is having 20 here. So 20% of the ordinary share capital. But now, the presentation of, unlike consolidated balance sheets, where we look at the minority in terms of the capital contribution and the surplus. Here, when it comes to the minority side, we are looking at the surplus of the minority. Take note. When we were preparing the consolidated profit and loss last week, we could see that when we get the total profits and we want to know the share of the minority profit, what do? We went ahead and take the profit after tax of the subsidiary and multiply the minority share on it to get the minority share of profit. We less from it before we get a group profit. So under normal circumstances, when I come here, I should have picked the ordinary share capital, which we were given to be 25,000, and multiply the 20% on it. Pick the preference share capital of 17,500 and put it here. That is what should have been the norm, or that is what we should have done. But now when you come here, what you go and look out for is to calculate the dividends. So I come here and then I say intra-group dividends. Now, I want to know the total dividend to be payable by the subsidiary. And I will know that by going to the subsidiary's income surplus account. The preference dividend payable is 1750. And you should know that, so let me write here, preference dividend is 1750. Ordinary dividends to be paid is 2100. Please, are you seeing it? You should be able to see where I'm picking the figures from. Ordinary share dividend to be paid by the subsidiary is 2.1 million. The preference share dividend to be paid by the subsidiary is 1.75 million. Now, we said in this dividend, 80, so for parents, let me do it this way so that you get the understanding very well. So parents minority. For the preference dividend, the parent will get 0. The minority for the preference dividend will get 100% of it. So what it means is that all the 1,750,000 or 1,750,000, sorry, will go to the minority. When it comes here, it's 80%. 80% of this will go to the parents. How much are you getting?
One eight, 1,680,000.
You like this.
Yes, please.
Then that of the subsidiary, the minority will get 20%. How much is going to be the minority's portion?
$420,000.
How much?
420,000.
420,000. This is going to be the
420,000.
yes, boss. This is going to be the minority's portion over there. We were also told that the parent bought the debenture. So for intra-group interest, so interest payable by the subsidiary. When you go to the question, debenture interest payable, by the subsidiary is 6 million. Have you seen it?
Yes, sir.
Good. And the parent bought 25% of that.
$1,500.
Is that?
$1,500.
1,500
Yes, please.
in that order. Now they made some statement. I want to look for that particular statement. Okay. So this is how you do your demarcations or you do your segregations. Now, if I come here and I say stated capital, for the ordinary share dividend, I must know how much is going to the subsidiary. Now, just like we calculated earlier on, you go and pick the total profits or the total surplus of the subsidiary. So you go to the income surplus account. The profit after tax is how much? Profit after tax of the subsidiary is how much? You wanted to see profit after tax, then you know that is it, eh? How much is the profit after tax of the subsidiary? How much is the profit for the year for the subsidiary?
$9,800.
So 9,800 is the same as the profit after tax minus the minorities dividend receivable. This one 1750. Then you multiply by the 20%. How much are you getting?
$1,610.
How much?
1,610.
Okay. Preference dividend. The preference dividend here is 1750. So the minority is getting everything. So all the 1750 will go to the minority. Then unrealized profit is going to be 20% of the 40,000. How much are you getting?
8,000.
You are getting 8,000. So you write only 8 over here. The total will be how much here?
$3,600. Yeah, that's it. 3,360.
I have to be writing it fast because if I have to be depending on you people for calculation, we will not finish here today. So that's how you prepare your minority interest accounts. Then we now proceed to prepare your consolidated income surplus account. So I'll copy it here and then I'll explain it. Also, you guys are not giving me the total, so we'll not move fast. So your consolidated income surplus account here to get this answer is the 125,000 that you have there plus the 50,000 bracket close minus the 5 million. So we are assuming that there is some 3 zeros to at the top. That's how you get a turnover over there. To get the cost of sales, you have the 50,000 plus 20,000 bracket close minus you made a cost of sales. You did some calculation here. Where is it? This one. $4,960,000. So minus the 4,960. You should get this particular one over here. Distribution costs is the same. Distribution costs, you are given there to be 10,000 and 4,000, so you get 14,000. Administrative expenses 8,000 plus 3,200. You get 11,200. So when you less these two from 8, you should get the 79,760 that they have over there. To be the operating profits. Debenture interest payable by the parent, it is 19,000. Plus 6,000 minus 1,500. You know the debenture interest payable when you calculate the 25% of the 600,000 or 6 million, so it is 1.5 million. So 1,500. Bear in mind, we are shortening 3 zeros out of it. You get a debenture interest payable. You less from it to get your profits before tax. The tax is straightforward. You just add the 2 tax, you get this 21,000. Tax here is 14,000 plus 7,000, you get 21,000. You get a total profit after tax. Then just like we did for illustration 1, you go and take the profit after tax of subsidiary, multiply the minorities percentage on it, and then subtract here. Here we have already worked it out. And we said our minority total is 3,352. So when you need a minority surplus, you just pick this 3,352 here and come and subtract it over here. Then you get your group profits. That is the very first step. So this ends my consolidated profit and loss account. I'm going to prepare my income surplus account for the year ended 31st December 2011. And I need my surplus brought forward. Surplus brought forward, when you go into the question, no, you have already solved for it. Bear in mind, this consolidated income surplus account now becomes your opening income surplus account. So you pick this total 25,844 as the opening income surplus account balance here. 25,844. Then you add your group profits. Your group profit you had is 31,908. Let me let my income surplus come in so that I have it on one page. Then you come and less your dividend. So preference share dividend to be paid by the parent is 5,500. Ordinary share dividend to be paid by the parent is 8,000. When you less from it, the retained earnings you get should be this. This is how your income surplus account will look like. Any question? Any question? So if you don't have any questions, we'll draw the curtains down for today, and we'll meet next week in lecture hall. Good night.